Welcome back. You're watching Your World at 10. Today was the day the monetary policy got announced. SLR was hiked from 24 to 25%. NPA norms, that's provisioning cover for NPAs, has been increased. Real estate provisioning hiked from 0.4% to 1%, but no change in rates. That, in a nutshell, is today's monetary policy. You've heard through the day various reactions to that policy coming in. Tonight, joining me is one of the leading voices on the economy, the chairman of HDFC, Deepak Parekh, joins me all the way from Berlin. Mr. Parekh, thanks very much for joining me, and sorry to trouble you whilst you're traveling, but what do you make of today's monetary policy and the signals it sends out?
I was happy with the policy. As I said, I was happy with the policy because there is a little bit of bubble being created again in the commercial real estate side. Main reason being there's a surplus real estate entirely in the country, in the entire country, and so increasing the risk weightage in commercial real estate, I think is a welcome move. You see, what is happening is the IT space and the commercial real estate space is surplus in most of the cities today. Apart from that, there are a large number of projects which are still in the mode of construction. So more space will be available in the commercial real estate. So we are going to have a glut in commercial real estate, which includes IT space. So the Reserve Bank has very rightly said that definition of commercial real estate includes discounting of rents, loans to developers for commercial real estate, investment in equity of developers that are doing commercial real estate, derivative transactions, and they've combined everything and they've said that everything is included in commercial real estate. So I think it's a move in the right direction. Even on the non-performing loans, I think making it mandatory for banks as of September 2010 that 70% of NPAs must be provided for. This is a new regulation that has come up. Again, I think it's a step in the right direction. It's cautious, it is precautionary, and it's conservative, but I think it's necessary. On the third point of increase in SLR, I would have thought that a CRR increase of 1% rather than an SLR increase would have better impact, because today banks are anyway sitting with excess securities, and the cash which is there with the Reserve Bank is not going to disappear by increasing SLR, because most banks are carrying higher SLR than mandatory required. While if they had increased the CRR by 1%, about 42,000 crores of the 1 lakh crores which are lying with the Reserve Bank for the last 3-4 months would have straight away disappeared, and the surplus liquidity in the system would have come down.
Mr. Parekh, what purpose do you think then has been served by hiking the SLR from 24 to 25%? Because if you believe that liquidity tightening was better done by a CRR hike and that's what should have been done, then what does the SLR hike help achieve?
Well, I personally feel that the SLR increase is a signal that interest rates will rise in India. It's a sign that the bottom has been reached on interest rates. It's a sign that RBI is concerned and worried about inflation. Not only the CPI, but even WPI will start moving up. And I think it's a signal to the market that be prepared for higher interest rates. May not be 5 or 6 points more, but at least 1 or 2 points more, 1 or 200 basis points more.
All right. Mr. Parekh, do you expect that this enhanced provisioning, both on account of provisioning cover for NPAs as well as real estate provisioning, will help, will go some way in sucking up liquidity, or is it more, like you mentioned in brief a little earlier, to prevent an asset bubble, especially in the real estate sector?
I think, first of all, the 70% of provisioning norms for all assets, for all lending, really, in the past, we had to provide 10% now, and it was dependent on a period of time.
Sure.
You could make provisions over a period of time depending on the tenor of the loan.
Right.
It did not have to be done front-ended, like now what the RBI says by September 10, 70% of your NPL must be provided. So it's more caution. It's more precautionary. It is more to be ultra-conservative. And if it's an NPA, it's an NPA. It's not going to disappear over 5 years. So why take a long time to write it off? Even if it's a 5-year loan or a 10-year loan. So at least 70% you make a provision in year one. So I think it's more conservative approach. Banks are having good profits. So it is going to impact some of the banks because you have to put larger provisioning, but they've given 1 year almost. So I think it's very fair.
Do you expect, sir, that the real estate provisioning hike will increase the cost of funds for developers? And will that be of any substantial impact, considering that most developers are not really looking for debt, but instead have been sort of making advantage or taking advantage of the equity window to be able to deleverage?
I don't think it will help. It will impact in any big way. It is marginal. It is trying to protect banks' balance sheet. It's not going to significantly increase cost of borrowing by developers. It's just a kind of warning that commercial real estate bubble and surplus commercial real estate is a concern to the central bank.
All right, Mr. Parekh, when do you think that rates will move up in the economy? Because in the governor's interaction with the media today, he said that he thought there was scope for banks to reduce lending rates even further over the next few months. So is there room, for instance, for home loan rates to come down? And conversely, when do you think that signaling rates in the economy will start moving up? As early as December or only next quarter?
I personally feel that this is just a signal. I don't see interest rates moving up in the next 2-3 months. Maybe in March, when there's always a scramble for funds, you may see a little hardening of interest rates. But till March, I do not anticipate, irrespective of the government borrowing. Bulk of the government borrowing is already being done. So I do not see interest rates hardening in the next 2-3 months. Possibly in March, there may be a little bit of a hardening of interest rates. So far as reduction of rates are concerned, I think there is a scope. I think Governor is right. I think you will see some of us streamline our lending rates a little bit, but marginally, not significant.
All right, so final question then. Considering that the RBI has moved its inflation forecast all the way from 5% to 6.5% for March 2010, this seems to be a strong bet on growth, considering the fact that he hasn't cut or hasn't increased rates at all. Do you assess this policy as a bet on growth so as to not stifle an economic recovery?
I think the Reserve Bank is banking on growth, and you've seen the IIP numbers have been very positive. And, things are looking up. The quarterly results of practically every company is better. In October, you see the results that have all come out have been very encouraging. And many of them have beaten analysts' forecasts. The growth is there. The profits are there. So I think they are betting on growth, and I'm sure they will get the growth. And maybe even be surprised at 6.5% GDP growth. It may be 6.7, the way we are going.
All right, Mr. Parekh, thanks very much. Again, apologies for bothering you whilst you're traveling, but it was great to have you on the show. Well, that was